Wealth is something we all want, right? So how do we build it? Then, how exactly is your estate taxed? We get into the nitty-gritty and the dangers of stock trading. All this and more on today's episode of The Wealthy Life. Welcome to The Wealthy Life. Building wealth is easy once you know how. Joining us today is Doug Allen, CPA and author of A Fighting Chance, to discuss with us some tips on how to start. Doug, welcome to the show.
Thanks so much for having me.
So how do we get started? Where do we build wealth from?
You know, getting started can be intimidating. Money is a complex topic and education is key. Early on, building those foundational knowledge bases about risk and compounding and inflation and all these components of building wealth are foundational. And then one can go and start putting together a plan and goals, because it's much easier to put money away every month if you have a plan that you're excited about building wealth for.
Oh, I so agree. I mean, who thinks about, well, if I put $300 a month now, 40 years from now, my life is going to be great. Well, who cares? It's immediate gratification. Absolutely.
And you know, early on, it's so important because the power of compounding is more and more powerful given the time you use. So the example I always use is the TFSA account in Canada. We have $5,500 every year to put away.
Actually, it's $6,000 now and going up every year.
Outstanding. So you put $5,500, $6,000 a year away for 47 years, from when you're 18 years old until when you're 65. And that earns, say, 7-8% per year in an ETF. By the time you're 65, you have $2.53 million. But of that amount, half of it is from the contributions you made in those first 10 years.
Half. So I want viewers pay attention. Half that wealth is from the first 10 years. So what you're saying is it's really important to start early.
Absolutely.
So is it too late? What if people are already in their 40s and 50s? Do they just give up?
No way. Never give up. You just have to adjust your approach. So maybe if you're a little bit older, it means taking a little bit more risk in your portfolio, scrimping and saving a little bit more, but never give up. Always be working on building your wealth.
So when I think about the power of compounding and starting early and starting young, when should kids actually start saving?
You know, to open the most efficient tax-enabled accounts, it's 18 years old. But I always like to encourage parents to get their kids involved in money as soon as possible. So I get my 5-year-old and 8-year-old involved in taking aluminum cans back to recycle for 5 cents, and they love it. And it gets them into the mindset. And then once the kids are in high school and older, they're in that mindset of, okay, I can make money, I can put money away, and it'll grow over time.
So what do they do with that money from the pop cans? Do they put it in a savings account?
I give them some of it to buy toys with, and the rest put them in a savings account.
Oh, good for them. They'll be set. They'll maybe have millions of dollars by the time they're 65.
That's the plan.
Thanks, Dad.
Yes.
What are some of the common mistakes people make?
Well, early on, credit cards are a dangerous tool, right? It's important to build credit, and it's important to have a credit card, but often young people spend on things that are not good for their wealth, such as dining out, such as vacations, such as cars. And this sort of interest of 20% is also compounding, right? And compounding goes both with assets and with liabilities. So steer clear of those high interest rate debt products.
Well, if you're going to use a credit card, use it to maybe collect the points, but pay it off in full every single month.
That's right.
You'll never pay a dime of interest, and you'll build great credit at the same time.
That's right.
So what should people be watching for when it comes to good debt versus bad debt?
You know, for me, debt is a tool, and it's a sharp tool, right? You can cut yourself with it if you don't manage it responsibly, but it's also a great tool to help accelerate your wealth building. So if you're going to go into debt, use it to buy assets that either produce income or appreciate, that allow you to help service that debt if the asset fluctuates in value over time.
So how should people be investing their money? I mean, not all investments are created equally. And I don't mean giving specific investment recommendations, but what can you add to that?
My philosophy is keep it simple. And I always point back to this famous bet that Warren Buffett made with a fancy New York hedge fund manager in 2008. And he bet that the S&P 500 passively managed index would outperform a big fancy actively managed hedge fund. And guess who won? Warren Buffett, and he made $1 million on that bet. So keep it simple. Stick to just funds that have low management fees and you can put away and forget.
Okay, what about things like bonds and GICs versus stock? Does it make that big of a difference over the long run?
It absolutely does. Right now, we want to look at where we're at in the interest rate environment, inflation, and figure out, are these fixed income products like bonds and money market securities and cash, are they even keeping up with inflation? So when we have high inflation and low interest rates, we need to look at moving money into higher earning assets so we can keep up with inflation and build our wealth.
Yeah, and generally the longer time horizon you have, the more risk you can take. And what I mean by risk is the ups and downs in the market. You can ride them through. But if you were going to put $10,000 into the market and you needed that money in 6 months for a car or a down payment, maybe not a good idea. But if you put $10,000 in and you don't need it for 40 years, you're probably going to do okay in a well-diversified stock portfolio.
That's right. And when we go back to the example of the TFSA with $5,000, $6,000 per year contributed over 47 years, if that same portfolio earns 2% per year versus 8% or 7%, now you're talking 400,000 at the end versus 2.7 million. So the compounding effect, it adds up with higher rates of return.
So key messages is start early, invest while you can, invest wisely, keep it simple, and have good debt, not bad debt.
Perfect.
And for more tips, we do have a few copies of your book to give away, A Fighting Chance. So contact us at thewealthylife.com. Doug, it was fantastic having you here today. Thank you very much.
Thanks for having me.
And when we return, learn how your estate is taxed and what to do about it.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. Whether you are leaving an estate behind or receiving an inheritance, do you understand the tax implications? Joining us today is Paula Lester, Senior Trust Advisor, to discuss with us how estates are taxed at death. Paula, welcome to the show.
Thank you for having me.
Now, people don't like talking about death, and they definitely don't like talking about taxes. But it's important to understand how estates are taxed because it makes a difference to how much beneficiaries may receive. Explain to us what we should know.
Absolutely. Yes, you're entirely right. There's a lot of myths out there about estate taxes. And there's also sometimes confusion between estate taxes and something called probate taxes. So a lot of clients, a lot of individuals will say, I want to avoid probate taxes. And what they don't realize is that, first of all, not all provinces have probate taxes. The main provinces would be Ontario, BC, and Nova Scotia, who have probate taxes between 1.4 to 1.6%. But that's not actually the large ticket. The large item is estate taxes. And what happens is when an individual passes away, they're deemed to have disposed of all of their assets on the day that they have died. What that means is it's as if on that very day they sold all of their real estate, pulled out all of their RSPs or RIFs.
All their stocks that they made lots of money on.
Exactly. And so they'll have the tax consequences that they would have had they actually done that while they were alive. What makes it a really heavy tax burden is that they've done it all at the exact same time. So, for example, your principal residence, you won't actually pay any tax because currently it's protected under the principal residence exemption. But if you had a cottage property or an investment property, you would have the gains on that property.
Oh, and those can be quite substantial. So if you think about a cottage that you bought 50 years ago for $40,000, and maybe it's worth $1 million today, at death, it is deemed to have been sold. So that would trigger a $960,000 capital gain that you have to pay some taxes on.
Exactly. And so for a lot of individuals, throw in on top, for example, a RIF or an RSP of, let's say, 400, 500,000, that's all included in income in the year of death. It pushes a lot of individuals into the highest tax bracket. And so whereas during your life, maybe you were paying a tax bracket of 30%, when you pass away, you're being taxed at the highest marginal rate above 50%.
That's because you're hit all at once with a lot
All at
of
once.
taxable income.
Exactly.
So is there some things that people could do to minimize the tax?
Absolutely, yes. So one of the big things is that when an individual who passes away has a spouse, so either common law or married spouse, and they leave some or all of their estate to that spouse, any assets that that spouse receives can actually be rolled over. So you can actually defer the taxes until the other spouse has also passed away.
Okay, so at the death of the first spouse, it's not a deemed disposition. It just rolls over to the surviving spouse. But when that spouse passes away, that is when the taxes will be paid.
Exactly. You have to, make sure that you're filling out the paperwork properly, working with an accountant, but you can bypass the tax until both spouses have passed away.
Now that could create some complications if it's a second or third marriage for some people, in terms of who's going to pay the taxes and who's going to get the benefit at the end of the day. But again, I guess they can work with an accountant and a lawyer to plan that out in advance.
Exactly. I mean, taxes are only one piece of the estate plan. You want to make sure that you're fulfilling all of your needs and wishes, and not letting the tax tail wag the dog, so to speak.
So does the beneficiary have to pay any taxes on the money they receive?
So once taxes have been paid, beneficiaries in Canada will receive their inheritance tax-free. So you don't need to include it in income for yourself when you're receiving an inheritance. That might be different if the beneficiary is outside of Canada. Their country or state may have taxes imposed, but from a Canadian standpoint, it's received tax-free.
Right, so in Canada, there is no inheritance tax, but the taxes are due and payable by the estate before the money is released out to the beneficiaries. So there still is some planning that needs to be factored in. Now, earlier you talked about probate fees and probate taxes. Should people really be worried about that?
I mean, it's nice to avoid it if you can, but again, probate at maximum, depending on where you live, is going to be 1.6%. It's not a huge cost to the estate. And so again, you want to make sure that whatever planning you do to avoid probate isn't overriding the other estate planning objectives that you have.
Well, Paula, is there one last tip you can share with our viewers?
Definitely. So my main tip is always, when you're planning your estate, make sure you get the appropriate help. Meet with your lawyer, meet with your accountant, make sure it's done from a very holistic standpoint. So you're addressing not just taxes, but everything else that you need to worry about.
That's great, Paula. Thank you so much for being with us today.
Thank you. It's my pleasure.
And don't go away. Up next, avoid some of the common mistakes made when trading stocks.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. Stock trading is easy, right? Maybe not so much. Here with us today is head trader at Raymond James, Mike Hope, to share some common mistakes and how to avoid them. Mike, welcome to the show.
Thanks, Sybil. Glad to be here.
So how many years have you been trading stocks?
Oh gosh, it's been about 28 years now. Started in 1993, and it's been a long time. Seen a lot of things.
You've seen a thing or two
Yes.
along the way. So what are some of the most common dangers you see people faced with when they're trading stocks?
Yeah, I think just the assumption that the markets are pretty basic. So the markets can get quite choppy and complex at times. So the main thing is just understanding that they are markets and they're open to many access points.
So you need to know what you're doing. When are the markets even open? I hear people trading in the middle of the night, but that doesn't make sense. Maybe you can elaborate.
Yeah, so the North American markets, if we kind of focus specifically on Canada, we chop it up in three sections. You've got a pre-open market, which goes from 7 a.m. Eastern to 9:30 Eastern. And then you've got the market as we know today, where all the fun happens, is between 9:30 and 4 p.m. Eastern. And then you've got a small closing post-market session, which goes from 4:10 to 5 p.m. Eastern.
Okay, so what happens in the pre-market and the post-market? Because the average person doing their own trading is trading during the regular market hours, correct?
Correct. Yeah. So the pre-market session, that's when all the markets kind of open their access points to all the vendors entering orders. Overnight orders are coming in, getting posted in the, if you want to call it a sandbox marketplace, and that's where pre-market prices are established. Once the pre-market comes to the final head where the actual regular market opens, there is a calculated opening price, and that is based on the kind of supply and demand of all the matching orders.
Okay, so if people don't know about this, how does that impact the average investor?
Sure. So let's just say you're an average investor. You place an order overnight. Your order goes into the marketplace. You're expecting to see an opening price if it is a market order as soon as the market's open.
Okay, so if I'm going to enter a market order, that means I'm going to accept whatever price the market opens at.
Correct. So that's based on supply and demand of the buys and sells at that given time. And it's called a calculated opening price.
So it's a risk. You don't know. And what if that price isn't acceptable to you? What can people do to avoid that risk?
Yeah, so that's where we kind of always encourage investors to think about prices, think about limit orders as opposed to market orders. Then you kind of know where you're going to end up at that market open. And sometimes you don't get the price at the market open. Your price is maybe outside of where that opening price is.
Okay, so you take the risk of maybe not buying or selling the investment as planned because your price was out of the market range. So a limit order is simply when you specify a price or a price range.
That's correct. Yeah.
Okay.
Yeah.
So if I want to buy ABC shares and I think they're worth $52, I may put a limit order in up to 53. But if it opens at 54, I won't get filled if I put a limit on it.
That's correct. Yeah.
Okay.
Yeah.
So there's a lot more moving parts to this than meets the eye.
Yes.
Is stock trading for everybody? Like, there's people out there who are terrified of trading stocks, and maybe they're thinking about short-term day trading,
Yep.
which, by the way, I think is gambling.
These days it is. It's a roller coaster ride, especially when you're talking about the flavor of the day stocks.
Okay, so that's gambling, and we're here to talk about investing, which
Correct.
means longer-term, smarter trading activity. Who is it suitable for versus not suitable for?
Yeah, so I think the thing with trading, and if just as you commented, these days trading, investing, they are kind of lumped into the same conversation. But when it comes to investing, it really doesn't have to be as stressful as one might think. These days the retail investor is got such a market impact. It is just amazing to see how many people are in the market, and maybe they don't even know that they're in the market.
Right, they maybe own a mutual fund or an ETF, and they don't think they own stocks, but in that mutual fund or ETF is a whole basket of stocks.
Correct. Yeah.
And when you think about the type of stocks out there that are good investments, they're typically, good companies with good earnings or good earning potential.
Yep.
Maybe pay dividends, maybe not. But people don't have to do this on their own. And I think all the little nuances that are part of successful stock trading, the average person doesn't have time or knowledge to do, would you say?
You hit that bang on. Yeah.
Well, that's why we've got people like you, Mike, to help keep us focused and do our trading for us.
Yeah. I mean, we've been, we do this for a living. We know what we're doing. And so, it's just kind of secondhand for us.
Well, Mike, thanks very much for being with us today.
Thank you. I've had a great time being here. Appreciate it.
And after the break, learn how to increase your cash flow.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. Thanks for your letters, emails, tweets, and messages. Today's question is from Raven. Dear Sybil, There are so many things I'd like to do, but don't seem to have enough money. I'd like to travel and increase retirement savings. How can I increase my cash flow? Sincerely, Raven. Raven, great question. And there's 3 ways you can increase your cash flow. Number 1, you can increase your income, and I'll give you a few examples. Number 2, you can decrease your expenses, and we'll also talk about that a little bit more. Or number 3, you can do a combination of the 2 together. So let's talk about your expenses. Have a look at where your money is going today. Separate that between wants and needs. If you're spending on wants over needs, you might be throwing some money out the door that maybe you'd rather reallocate to something more important. When you have a look at where your money is going today, it can help you make more intentional decisions. Quick tips on ways to cut expenses, which will put more money in your pocket. Maybe cancel your cable or take a smaller cable package. Maybe revisit your cell phone plan. Maybe cut your coffee habit in half or eliminate it altogether. Make coffee at home. Maybe make lunches instead of going out for lunch. And maybe look at the number of subscriptions you have. Maybe some of them you don't even use. When it comes to increasing your income, maybe ask for a raise. Maybe look at getting a second job, or maybe doing a part-time home-based business to bring in a little bit of extra cash flow. When you put all of those things together, you'll have a little bit more money that you can spend on those things you want to do. And the secret to your retirement goals is put 10% of your income right into savings no matter what. And that wraps up this edition of The Wealthy Life, helping you make smart financial decisions. Join the Wealthy Life Club and you'll gain access to everything you need to live your version of the wealthy life.